Hi, this is Alessio. Hope you're well. So one of the biggest misconceptions and lies about the markets, which a lot of people believe in, has once again been destroyed. It's been disproven, debunked. So what am I talking about? Well, guys, as I'm sure you know, last year, around about October, November of last year, when the stock markets dropped quite heavily, as you can see there, a lot of people at the time, including economists and I would say analysts, or as I call them, analysts, because they talk out of their backside. But essentially at the end of last year, a lot of economists, YouTubers, analysts said that the markets could not possibly go up or rally because of QT. In other words, quantitative tightening. Now, essentially, as I'm sure you know what that means, it's when the Federal Reserve is raising rates. So the dominant belief or idea at the time in December, November of last year was that the markets could not possibly go up or rally because the Federal Reserve is raising rates. In other words, doing QT. Now, I said at the time, as you remember, in December of last year, that is wrong, that is false. And I said, actually, the markets can go up when the Fed is raising rates. In fact, here's a very short clip from December and we'll come back. The first objection people had was, well, how can you say the market can have a rally when the Federal Reserve is raising rates? I think that is a very simple answer to that. First of all, you can see in the last several months of this year, we've had several big rallies. For example, in the spring of this year, the stock markets, the S&P went up 12% despite the Federal Reserve raising rates. In August, from June to August of this year, from the June lows to the August highs, the stock markets rallied by just close to 20%. That was despite the Fed raising rates. And more recently, we've seen the Dow Jones. The Dow itself has had a tremendous rally despite the Federal Reserve raising rates. All right, as you heard in that video from December of last year, I said it's quite probable that the markets could go up and rally even when the Fed is raising rates. And I remember at the time, I got a lot of people saying, no, that's surely wrong. That cannot possibly happen. So as you've seen, obviously, in the last several months, from January, from December of last year, the markets have rallied as we expected. In fact, one of my targets on the S&P has just recently been reached at 4417. I think we completed wave 1, wave 2, and now we are in the wave 3, taking us at least, at a minimum, to 4457, 4417, and yes, 4311. So you're probably thinking, okay, how is that even possible? How can the markets go up when the Fed is raising rates, when it's doing QT? Well, guys, as I've said many times before in our videos, the markets are not rational, okay? The markets do not have to make sense. The markets, whether it's stock markets or Bitcoin, doesn't really matter. But anytime we think that the markets have to make sense and be rational, the markets show that's completely wrong. And by the way, if we make the mistaken assumption that the markets have to be rational and make common sense, two things will happen. Either we'll lose money or miss out on opportunities. Guys, I can tell you, I probably lost so many opportunities in the past several years because I've thought mistakenly that the markets have to be rational and act like common sense. Now, you're probably thinking, well, why is that? Why is it that the markets are irrational and they don't have any common sense? The reason, as I've said before, is because the markets are driven not by the Federal Reserve, not by fundamentals, mumbo jumbo, and that garbage. No, markets, and again, I mean any market, whether it's Bitcoin, stock markets, gold, so on and so on, they're all driven by two things: by emotion, by sentiment, by fear and greed, by anxiety, by euphoria, all those human emotions. So essentially, markets are driven by psychology and sentiment. So that's why, guys, I warned last year, and I'm warning again, that it's useless to try to interpret the market or try to anticipate the market or predict the market based on fundamentals or the news or any of that nonsense. All right, guys, it's best to just ignore that stuff and instead focus on the charts, focus on the price action. As we said before, price über alles, price over everything. Now, of course, in the most recent Federal Reserve meeting, we heard that the Fed is going to pause raising rates temporarily before probably raising them again sometime this year. Now, I think at some point in the near future, maybe at the end of this year, maybe next year, they might start cutting rates. And that's going to be very interesting indeed when the Fed decides to cut rates. If you want to know why, make sure you watch my previous video from December. I'll put the link for that in the description. Before I finish this video, I just want to ask you a quick favor. As I'm sure you know, we're getting very close to Independence Day or July 4th. Now, I think what would be a great present for someone, maybe for yourself or someone you know, would be a fantastic book on American history or the Founding Fathers. And there's a great book by the historian Darren Staloff, which is called Hamilton, Adams, Jefferson. By the way, just to let you know, he's not a sponsor, so I don't get any commissions from mentioning this, but I'm only mentioning this because I think Darren Staloff is a fantastic guy. He's a very knowledgeable person when it comes to history and also philosophy as well. If you haven't seen his philosophy lectures on the Michael Sugru YouTube channel, go ahead and check it out. They're brilliant, and you can learn a lot from them. So again, I think this is a fantastic book. Do check it out. It's on Amazon. I'll put the link for you guys in the description. Again, it's called Hamilton, Adams, Jefferson by Professor Darren Staloff. Thanks very much indeed, guys. Cheers.